Hi, this is James Shugg at Westpac's London office with the end of day report for Tuesday the 24th of July. Look, another down day for equity markets with Europe pretty much at the centre of attention yet again. Three different themes today. Firstly, Moody's, actually before the London Open, have put Germany, the Netherlands and Luxembourg on negative outlook. Now they're AAAs, AAA sovereigns. They've left Finland as a AAA with a stable outlook, but they're now questioning the ratings effectively of those other three, including Germany, because of the rising uncertainties over the European financial markets and economies. Now there's been kickback against that, not by the Dutch, they made no comment, but the Germans certainly. Angela Merkel insisting that Germany will remain a safe haven within Europe, and saying that the risks that Moody's cited have been around for a long time. But the point is, of course, that those risks are now materialising. And in fact, if the euro is to survive, Germany is probably going to have to make a bigger contribution to the southern peripheral economies that are in trouble at the moment. And that would put potentially the credit rating of the sovereign under pressure. If the euro were to break apart, Germany would probably have to recapitalise the Bundesbank because of how much it's owed by other central banks that make up the European Central Bank, and indeed the commercial banks in Germany would probably have to be recapitalised as well. So sort of whatever scenario you paint, it's going to cost Germany, and Moody's are reflecting that in their rating action today. Not action on the rating, but on the outlook. So that saw German bond yields push up a little bit, but not substantially so, because of what else was going on in Europe, and that includes the Greek Prime Minister Samaras saying that he thought the Greek economy might shrink as much as 7% this year and not return to growth until 2014, and even then only modest growth, and even then he's being optimistic. Basically, he wants an extra 2 years to meet the budget deficit reduction targets and something like another 40 billion euro of bailout funds. The troika of IMF, EU and ECB officials arrived in Greece today to basically look at the books and determine whether the latest bailout can be got back on track, or whether there need to be political decisions taken by Greece's European partners to go forward. Now, whether those political decisions mean being more lenient and giving Greece more money, or well, what was another one? Another debt restructure that was suggested today by some EU officials, or even something more abrupt than those. It all remains to be seen. But certainly that last bailout, which at the time was met with some relief, has proven to be woefully inadequate. The other issue is, so you had the rating issue with Germany and the other AAAs, you've got the Greece issue, you've got this Spanish issue. Now Spain is saying it's not seeking a bailout. Other European officials are saying that they're not working on a bailout for Spain, but they say they stand ready to act at a day's notice if required, which doesn't inspire much confidence, and it's one of the reasons why 10-year bond yields in Spain remain above 7.5% today. Even Italy, where it's not so much a disorderly sort of breakdown of the market there, we're just seeing a gradual realisation of the inevitability of it all, I suppose, with 10-year bond yields there rising too. They're at about 6.5% today. I mean, there is still this possible solution whereby the European Central Bank steps in to fire up its securities markets program, probably do it unsterilised, so it simply expands its balance sheet and uses that to buy bonds of countries like Spain and Italy, hold them till maturity, don't take seniority over other investors, and that might then hold yields down at more affordable levels for those governments. So they've got a bit more time to put in place the competitiveness and measures, the economic reform measures that need to be put in place for them to operate successfully within a single currency area. Now, the ECB doesn't want to do that. The Germans don't want it to do it because they think it would be inflationary. But increasingly, it's looking to investors like that maybe a little bit of inflation risk is worth taking when the unknown risks of euro breakdown or sovereign default could be much more devastating for the European economy as a whole. So that's one to keep watching. We still think the ECB will step in at some point this year. On that point, the European composite PMI for July was steady at 46.4, but that's still the fourth reading in a row where it was below the level it reached during the first couple of quarters of the recession back in 2008. So it's pointing to a pretty recessed European economy at the start of the third quarter. On our figuring, the recession in Europe actually began around September last year. So given we're at the end of July, we're almost a year into recession now in Europe, in Euroland that is. We had sharply weaker mortgage approvals data in the UK. Well, that may be related to the public holidays in June and the weather, which was may have kept people away from trying to get a mortgage. And in the US, the Richmond Fed factory survey fell very sharply from -3 to -17, more in line with the weak Philly Fed survey than the bounce that we saw in the July New York Fed survey. So some disappointing numbers in the US today as well. So given all that, some pretty disappointing news out of Europe, a bit of disappointing news out of the US, and ongoing weakness in European economic numbers. The FTSE in London down just 2/3% today, the French market down 0.9%, the German market down 0.5%, the Spanish market down 3.6% today, down 20% actually since the beginning of July, the Spanish stock market, and the Italian market down almost 3% today. The Dow, as I speak, it's 6 o'clock in London in the evening, it's 1 p.m. in New York, and the Dow's down 1.2%, with the S&P 500 loss a little bit steeper at 1.3%. The level of the Dow is 12,570. In commodity markets, we've got copper prices down 1%, gold down 1/3% at $1,572 an ounce, and oil is up 1/4% actually, at $88.37 a barrel. I dare say that's got something to do with the Middle East. And the Aussie dollar, well, it's actually fallen about a cent in the last hour or so. It was at 1.032, it's down to 1.022 at the moment against the US dollar. And we've got Australian inflation figures coming up tonight, which will provide a bit more guidance to the Reserve Bank in terms of their assessment of where inflation's been and maybe just where monetary policy might be going from here. Okay, I'll be back with more tomorrow.